Interest rates are higher than we've seen in years, and a lot of investors are struggling with cash flow right now. But guess what? Smart investors are still making money and optimizing returns even in today's high interest rate environment. In this video, I'm going to show you exactly how to boost cash flow. I'm going to give you some proven strategies to increase cash flow, cut expenses, and overall put more money in your pocket. Now, I'm going to give you 3 plus maybe even a bonus if you're lucky at the end. I don't know if you're going to like them all, but I promise they all work because I have proven that they work. So if you're willing to roll up your sleeves and learn a little bit about how to buy rental properties at cash flow in today's market so that you can start to build long-term wealth, you're gonna wanna listen up. Strategy number 1 is pretty simple, but I am gonna break down some details so you can actually do it, and that is get better financing terms. Now I'm talking about on the front end and on the back end. If you're utilizing the Burrs method and using a private money lender, there are strategies that you can utilize to lower the interest rates with a private money lender. A typical private money lender is going to charge anywhere between 10 and 12% on the money they lend you to buy the property and to fix up the property. If you're able to get them down to, let's just say 7 or 8%, that will reduce your overall costs in the project, which will reduce your overall financing amount, which will of course lower your monthly payment. Now, how do you do that? It sounds great to just say it, right? But how do you actually do it? There are things you can tell a private money lender that will probably allow you to lower your percentage you're giving them. Now, that may sound crazy, but let me explain it. The first one is offering a personal guarantee. You see, I did this a lot when I started, and I still occasionally do. If you offer a private lender who's probably an individual that has some extra money that's pretty smart financially, a 10% return, but you're not personally guaranteeing it, but then you offer them a 8% return that you are personally guaranteeing, meaning you're putting your personal butt on the line that they're going to get their 8%. 8% is a pretty darn good return, and most of them probably realize that the stock market's at an all-time high and probably doesn't have a ton more upside before it goes back down. So planting that bug in their ear and personally guaranteeing an 8% return might allow you to lower your interest rate. You can also put them on the deed of trust or give them partial ownership in the property until they're paid back. Basically, what I'm saying here is offering them additional securities to guarantee their return and give them ownership in the property will probably potentially make them more likely to lower their interest rate slightly so that it might work for you. Now you can do that, and if that doesn't work, or if it does work, getting some better rates on the long-term financing will make the difference. I thought about saving this for last, but let's just give it to you now. So typically right now, if you're getting a $250,000 loan on a rental property, that's how much you're borrowing, a small local bank will be around 8%, and they'll probably give you around 20 years of terms on that loan. That is a $2,091 monthly payment. That is expensive for a $250,000 loan, and that is why very few people are buying rental properties and even less are cash flowing positively. However, if you're able to tap into a newer type of financing that hasn't been around that long called DSCR financing or debt service coverage ratio financing, you're able to get much better terms. So for example, that same $250,000 loan, if you're able to get a 30-year note at 6.4%, that monthly payment is $1,563. That is $528 less per month out of your pocket just by getting some better long-term financing. Now you may say, where can you get that? Well, you can get those terms at FasterFreedom Capital. So check the description after this video for a link to FasterFreedom Capital, because we are literally approving loans between 6.5% and 7%. We just approved one the other day for 6.4%, which is why I'm using that as an example, over 30 years fixed, which as you can see, can potentially add over $500 more in your pocket, which could potentially take a negative $250 a month cash flow, which one you probably won't buy, to a positive $250 a month cash flow, which is one you should buy. Plus, I'm gonna give you some other ways to cash flow more. Number 2, which is one you may or may not like, but is pretty powerful, is managing your rental properties in-house. Outsourcing your rental property management is not a bad thing, and a lot of people do it. However, it is costly. Your typical property management company is going to charge you 10% of gross rent, plus potentially fees to get the property initially rented, plus even more fees to get the property re-rented after 1 year and 2 year timeframes. Then also they're going to upcharge the maintenance that they're charging on the property. Their maintenance probably costs them around $45 to $50 an hour, and they're probably going to charge you around $70, $75 an hour. Now, if you're cash flowing positively and you don't have time to manage a property, this isn't a bad route. However, if this is what's holding you back, and if you can save some money here and go from not buying a property to buying a property, which means go from not creating wealth to creating wealth, then you should use a third-party property management company. So for example, the typical property management company charges about 10% of gross rent to manage your property. So if you're renting a property at $2,500 a month, they are charging you $250 per month just to manage the property. And they probably charge you at least half of that, so $1,250, to get the property rented initially. So as you can see, just on the management side, by managing in-house, that can save you a minimum of probably $250 per month, which is $3,000 a year, which may be the difference in cash flowing or not cash flowing. And managing a property, especially if you do it the right way as far as the BRRRR method goes, by buying it and fixing it up and making it maintenance proof, you're not going to spend a ton of time managing 1, 2, or maybe even 5 rental properties. The typical rule of thumb is if you set things up properly, have systems in place, have somebody maybe guiding you and teaching you, maybe a community, maybe a mentorship that shows you how to do things the right way, managing one rental property will probably take less than 5 hours a month to do and won't be a headache because you approve the right tenant and you have a nice property. You can also hire a VA or virtual assistant to help with a lot of the tedious tasks that may go along with communicating with tenants or collecting rent or anything like that. And there are VAs you can get for $5 or $6 an hour, maybe 10, 20 hours a week, that will do it all for you, and maybe some additional things that can help you take more off your plate so you can focus on buying more and cash flowing more. The third way to cash flow more in today's market is a little bit more long-term of a play, but it's the most guaranteed out of all of them. Well, I guess they're all pretty guaranteed if you do them the right way, but this one is reducing turnover. Turnover is the silent killer of cash flow that very few people talk about, that is your most expensive aspect of owning rental properties. Think about it. When a tenant moves out, you probably have some repairs that you can get out of the security deposit if there are any. There will definitely be some deferred maintenance things that the tenant didn't do that you have to take care of, so you have cash flow coming out of your pocket. You still have your mortgage to pay. You still have your insurance to pay. You still have your real estate taxes to pay. The utilities are now in your name. So the point is you have all this money going out and you're not collecting any rent to offset it like you would be normally while the property is occupied. So reducing the amount of times you have turnover will completely change the game for you. My tenants leave about every 4.5 to 5 years. So in a 10-year period, I have 1, maybe 2 times where I have a big outflow of cash with 0 inflow of cash. However, if you approve the wrong tenant and you get a stingy there, or don't take proper care of the tenant while they're living in the property, they will probably leave every year, maybe every 2 years. So you maybe have 5 or 6 turnovers, maybe more. Will I have 1 or 2? And I'm gonna get about 10 times more net cash flow over a 10-year period than you are, simply because I approved a good tenant, set the right expectations, treated them like people, managed them properly, and kept them in the property, all while you are potentially having a tenant move out every year or every other year. That one's a little bit longer of a play. However, if you're mixing in part of strategy 1 or part of strategy 2, and you do get a tenant in the property and you are cash flowing properly, you need to hold on to that tenant and do everything you can to keep them in the house, especially if they're taking good care of the property. And your bonus tip is getting into a different tenant base, such as a midterm rental. Midterm rentals are renting out on a 1 to 6 month basis to people like traveling nurses, corporate leases, digital nomads, insurance displacements, and things like that. They are way more common than you think. In fact, there are about 2 million traveling nurses in the United States right now, and there are about 250,000 listings on Furnish Finder, which is the place you go to get midterm rentals if you're a traveling nurse or a corporate lease. It's like Zillow, MLS, Realtor.com, Apartments.com, all combined for midterm rentals. most likely traveling nurses. So there is way more demand than supply. So having a midterm rental is way more beneficial than you'd think, because you can typically charge about 2 times gross rent. So if you're charging $2,000 a month rent on a property, you can probably charge close to $4,000 on a midterm basis. And you might be shocked at the fact that the average occupancy on a midterm rental is about 85, 86%. And the average occupancy on a single family rental long-term is about 95%. So you are getting a little less occupancy, and you may have a little more expenses because that tenant may stay there for 3 or 4 months. So you may have 3 tenants in a year versus just 1 tenant in a year, but they're traveling nurses, they're corporate leases, they're people that take really, really good care of your property. Most traveling nurses that I have rented to in my midterm rentals actually leave the property nicer than when they found it. They may add a picture or 2. They make sure to keep the property nice. Maybe they buy some nice towels that they like and they leave them there, because they're getting a stipend from their work and they're there to work. So they work 12 hours on, 15 hours on overtime, go home, sleep, work on, off. They're there to work. They usually just hang out, relax, and sleep and work the entire time. And if you're doing an insurance displacement or you're doing some type of digital nomad, they're there for a short period of time. And if they're not doing like a short-term rental Airbnb where they're partying for 1 weekend and leaving, they usually take really good care of the property. So that turnover that I talked about earlier is not as significant when you're talking midterm rentals versus somebody in a long-term rental living there with their family, their dog, their cat, their whatever for 12 months. So that midterm rental, while there may be a little bit more initial costs, maybe you have to furnish it, maybe there's a little more you put into the property, the fact that you get 2 times gross cash flow, which should equate to, at least 50% more net cash flow, that might be the difference in you cash flowing versus not cash flowing. So that's about 3.5 strategies that you can pull from to positively cash flow in today's market. Real estate is one of the very few investment strategies that gives you the flexibility and adaptability to try different things when the market throws different things your way. You can't control interest rates, you can't control a lot of different things, but what you can control is how you react and what strategies you implement to overcome those obstacles. So make sure you're subscribed to this channel and like this video for more future content on how to cash flow in today's market and how to buy real estate and how to do all the crazy things that me and my business partner Lucas do every single day. This channel can change your life if you're looking to have your life changed by real estate and investing strategies that work for everyone. I appreciate you very much. See you on the next one. Hit that like button. See ya.